All right. Hi, everyone, and welcome. I'm Kevin Davey, and welcome to Why is Everyone Making Money Trading Except Me? Uh, so I just have the webcam on just at the beginning just to show you I'm actually here live. And today is Monday evening in the U.S. I'm in Ohio and outside of Cleveland. And I know there's people joining us from all over. So just want to welcome you and thanks for taking some time to listen today. So I'm going to turn the webcam off. It'll just make it a little bit easier for me. And we can get started. All right. So here's what we're going to talk about today. Just to make sure I just want to make sure everybody can hear me. I forgot to ask again. If you can hear me, just type a Y in the question or the chat. Okay. Looks good. Okay. Thank you. So first we're going to talk about why you should even listen to me. You know, you hear a lot of trading stuff and a lot of people say things and a lot of it's kind of nonsense. So I'm going to try to explain why maybe you should listen to me. Just wanted to tell you there's no sales pitch here. I'm not selling anything. It's just going to be all pretty much good education, hopefully. And then we're going to launch into the big question. Is everyone making money? It certainly seems that way. And we're going to talk about that. How you can succeed in trading. And then at the very end, we'll have plenty of time for questions and answers. I'll stick around pretty much as long as I need to if you're asking questions. So, all right. So first, we put the friendly U.S. government disclaimer. Don't trade with money you can't afford to lose. Past performance is not indicative of future results. Any results I show are going to be hypothetical. My rule of thumb, anything you see anywhere is hypothetical unless it happened in your own account. Then you're safe. You treat it all as hypothetical. That's a good way to go. All right. So why should you listen to me? Well, I put up around my smiling face a few of the reasons why I think you should listen to me. I've won some multiple trading championships. I've gotten awards for my book and for my workshop. And I've also gotten some good online reviews. But first and foremost, I'm a full-time trader. And keep that in mind because there's a lot of people out there who sell stuff and that kind of thing, and they don't even trade. Or, you know, they refuse to show that they trade, which to me means the same thing. You know, if you're afraid to show that you trade, chances are you probably don't. And like I said, 2005, 6, and 7, I finished first or second in a trading contest, worldwide trading contest with real money. My book, Building Winning Algorithmic Trading Systems, was a bestseller at Amazon for a little while when it came out. And it's also won various awards in 2014 and 16. And then, just recently, my trading course was voted Trading Course of the Year by the people at Trader Planet, by the readers at traderplanet.com. So there's a lot of awards and a lot of accolades behind what I have to say. And I say that not to brag, although I guess I am, but it's really just to show you that my reputation and my pedigree is there. So take that into consideration when you listen to what I say. You know, I'm not just some person who's randomly posting on Twitter who never shows results, who you don't even know if they really trade. And if you go to tradingschools.org, you'll see I've gotten 2 5-star ratings there. And that's a great website because you see a lot of people who are basically just charlatans there, and they get exposed at that website, tradingschools.org. So, you know, check that out when you get a chance, and hopefully that'll make you realize maybe what I say is worth listening to. But again, it all focuses around my full-time trading, and I've been trading for over 25 years now. I think 8 or 9 of that's been full-time, and the rest was part-time. I was able to make that jump from part-time trader to full-time trader, which I know a lot of you want. You want to do that, and it's pretty cool when you can do it. I'll tell you that. It's people say I'm living the dream, and I really think I am, because I'm doing what I love to do, and that's develop trading systems and trade them. All right, so today, I'm not going to be the guy telling you why that particular malted beverage is the thing to drink. I'm not here with the sales pitch. And a lot of that's because of me. I just hate being sold stuff, and you guys are, I'm sure, are the same way. You're just inundated with emails and webinars and all sorts of ads on everything telling you buy this, buy this. And I hate doing that. And I realize, though, since I have a workshop, some of that happens sometimes. But I like to think that my material sells itself. And if you're interested in what I say today, you'll probably go to my website later and see what I have. And if you don't, hey, that's fine. If you don't think I have value, no problem. I had somebody last week who emailed me and said, well, I haven't looked at your website, but since you're selling something, I'm pretty sure you have no value. I was like, wow. But no sales pitch today. There's no special offer for anything or anything like that. We're just going to talk about this. Why is everybody cashing in except you? And here's just some of the ads you see on the internet. Double your account every 90 days. Lock in your profits. Somebody actually showed this kind of gains. And maybe if they took it out to 2 decimal points, you'll believe them more. Fantastic gains. Are they real? I don't know. I found this. Recently, Paul made $600,000 on one trade in 3 days. Wow. Well, good for Paul. He was probably demo trading, but you don't know that, right? We double our account every 12 days. So the people up at the top that said double every 90 days, that's not good enough. So these people double it every 12 days. And, financial freedom, they all talk about that. And so this is just a random sample of some ads I saw on the internet. Everybody's making money. And you're probably thinking, why not me? How come I'm not making money? How come I'm not making those stacks of bills where I can put them on in between the seats of my car, just drive around with thousands of dollars? How come that's not me? And you can go anywhere. Social media, you'll see friends, relatives, people who know somebody, friends of friends, and they're all making money. You go to Twitter, I don't think there's anybody who admits losing at all on Twitter. Everybody's making money all the time. It gets depressing, right? If you start to believe it, you're like, wow, how is everybody making money except me? Well, the big thing, it's not true. It's not true. The statistics are there. 90%, probably more than 90% of people lose money trading. So either you're unlucky to see those 10% who are just raking in money and just sharing it over and over again, or most of what you see out there are just a bunch of lies. And I tend to think it's the second one. It's just lies. People are not making money like you would expect based on what you see in social media and ads. And that is a huge thing to keep in mind when you're looking at your own trading, because it's natural. You compare yourself to what other people do, and you see everybody else making money except you, you start to feel like the dumb one. And, oh, I got to change my method. Oh, I got to go buy an expensive course. Oh, I got to go do this. I got to go do that. I got to double my size, and then it'll work out. Just remember, most of the people aren't making money the way they say they are. And if that still doesn't sunk in, well, just think about that. Think about it for a second. The picture in the middle are called the pajama ladies. Supposedly they're trading while they're knitting in China and making tons of money, supposedly. Well, if that's true, somebody's losing, right? Because futures is a zero-sum game. For everybody who wins $1, somebody's losing $1. So if the pajama grandmas are making money, tons of money, who's losing it? Hedge funds, professional traders? You think they're losing to these people? No way. No way. And that just kind of shows you how untrue what you see out there is. You got these kids right out of school, and they're driving their Ferraris and stuff because they're making so much money trading. And that gets, I see it. I see it. You see it. You get a little jealous. You're like, wow, how are they doing that? Well, the fact is they're probably not. And that's what you got to remember. You got to learn to recognize BS. And there's this really cool university class. It was a 1-credit class, I think the University of Washington. And there's the website. You can actually go and watch all their YouTube videos of the lectures. And I encourage everybody to go there and watch it. And you learn about some of the techniques that people use to create this BS. The fake results. Everybody's talking about fake news. Well, these are fake trading results. And this will help you kind of get in touch with how people are faking it and what to look for. But my rule of thumb is, the more fancy cars you see, the more chance that they're fake trading. They're probably not even really trading. But this is a great course. Some nice videos. So, okay. So people aren't really making money the way they say they are. People do make money trading. Don't get me wrong. But it's just not to the extent that you see online, on Twitter, on social media, on Facebook, and those type things. And all those ads you see on the internet, usually most of those are not true. And that's just plain simple fact. And this is what it comes down to. Most people claiming to make money are not. So they're either not making as much, or they're not even trading. Most of them probably don't even trade. And there's been a ton of people who've been exposed over the past few years who've been shown to be sim and demo traders. I mean, it's just ridiculous. And the fact is, most people lose money in trading. Simple as that. And most people selling education can't trade. So that's usually the reason a lot of people start selling education, is because they're losing money. And they figured out it's better to sell the gold mining equipment to the prospective miners than to try to mine it themselves. Fake testimonials, scams, they're all over the place. Binary options is a key example. If you've ever seen that, that's I don't know anyone who's succeeded in making binary options, but I'm sure you can find pretty much a ton of testimonials saying they have. Penny stocks, same way. There is so much incorrect information out there and fraudulent information out there. You really have got to protect yourself. Because like I said, and I've said it over and over again, trading's really hard. That being said, there's definitely ways to separate yourself from the herd of people who follow all this fake stuff. And that's what we're going to talk about now. How to succeed in trading. So here's a nice looking equity curve. Who would not want to trade this? So if you think this is worth trading, just type a Y in the question box. Yeah, and we're seeing a bunch of people, they'd love to. Okay, well, what did I say earlier? You got to ignore the BS. You got to be skeptical of hype. So when you see something like this looks almost too good to be true. And Lucas said too smooth. Exactly. Well, watch this little box right here. Because if it sounds too good to be true, it probably is. And look who's behind that curve. A guy named Madoff. You've probably heard of him, right? That was his equity curve that he would show prospective traders, investors, whatever. And he collected a lot of money with that kind of curve. It looked too good to be true, right? I think most people agree they would trade it, but it also looked too good to be true. And that's what it was. So again, it's that being skeptical, ignoring the BS. That's key. So I'll tell you what, over my trading career, the statement in quotes, if it sounds or looks too good to be true, it probably is, has saved me a ton because it's forced me to ask extra questions. So whenever you see something that looks too good, ignore it. So that's the first thing. Second thing, you got to have realistic expectations. Okay? What's realistic? Well, I always tell people that if your return is 2 times your max drawdown, you're pretty much in elite company. What does that mean? Well, let's just say you can handle a 10% max drawdown. Okay, which that's probably realistic for most people. Well, then, a 20% return is not extraordinary. It's probably in line. But look how when your drawdown goes up, your return goes up. So if you wanted a 100% return, you have to be willing to accept a 50% drawdown on average. That's a pretty hefty drawdown. Most people could not do that. But look at the last line. Let's just say you want hundreds and hundreds of percent, 500% return. What does this rule of thumb basically mean? It basically means you're going to risk your whole account to get that return. That you probably will blow up trying for that kind of return. Now, doesn't mean you will. You could get lucky. You could do it. I know people who've done it, and they're good traders, but at the same time, they knew what they were doing, and they knew they were risking a lot to get that kind of return. So that 2-to-1 return to drawdown puts you in pretty elite company. Commodity trading advisors, they hope for a 1-to-1. So here's a good example. Just these are the best managed futures systematic traders, which is kind of what I do. The best ones for 2016. Top 10 around 30% or higher. But look what you don't see. You don't see somebody with 1,000%. Now, granted, some of these firms are bigger. 300 million under management. That's pretty big. But this one's only 2 million. It's a little bit smaller. But you don't see huge returns. And you also see some pretty significant drawdowns. So, for example, number 6, they had a 36% return, but a 32% drawdown. So a 1-to-1 ratio, most managed money considers that to be pretty good. So I would say for retail traders, a really good benchmark is 2-to-1. If you're doing that, year in, year out, you're pretty much in elite company. So the point here is you got to be realistic up front, right? You have to have realistic expectations. And if you're thinking you're going to have return 10 times your drawdown, you're just going to be disappointed and you're never going to succeed. And that's key. All right. Number 3, you have to have a method and a plan. And I liken trading to being a surgeon. It takes time to get good at it. You just don't watch YouTube and, Google in how to be a surgeon. Hey, I'm going to watch this 2-minute video. Boom, I should be good. Yet, people do that with trading. Hey, I'm going to watch this 5-minute price action video and I'm going to be an expert. I'm going to open my account tomorrow. And you might be laughing, and some of you are commenting, but that's what people do. They think trading should be easy because they can watch it on YouTube and see somebody succeed. Well, next time you think that, think about if you would go into surgery with a surgeon who just watched a video on YouTube. You can't wing it. Before you start trading, you got to have an approach. And the key is it's got to make money in today's market. What does that mean? Well, you've got to have a method that has proven itself. And I'll tell you what, watching somebody sim trade successfully is not proof that a method works. It's proof they've proven they can sim trade. There's a big difference between sim trading and live trading, as you probably know. So you can't just wing it. And along those lines, okay, you have a method, you have a plan. Hey, I'm gonna be developing algorithms to help me trade. Okay, there's your method. Now you got to find an edge. And that's how you're going to make money. You got to test it. You got to verify it. It's got to be current, right? The turtles way back when made a bunch of money, but nowadays that's a hard method to make money with. So whatever you're doing's got to prove itself over and over again in real time. And you're probably not going to find it in some indicator. People are always selling indicators. The latest and greatest. Oh, it's based on chaos. It's based on genetic algorithms or, something like that. It's probably not going to get you where you want. But you've got to find an edge. And I always tell people if they don't know what their edge is, they probably don't have one. It's key. And the way I find edges is by testing and verifying that something has worked in the past. And that tells me, hey, this edge did work. Maybe it won't work going forward, but it certainly worked before. And that's key. You can find things all over the place that can help you get an edge, but I don't think you're going to find a trading system in a magazine you're going to be able to program and it works great and you start trading it. I've never had that, but I've taken those ideas, modified them a little bit, and then I was able to do things. So it can be pretty useful, but don't forget everybody's looking at these things. There's tons of people looking at Stocks and Commodities magazine. So you got to be willing to have that as your starting point and then go off and modify it. But that would work. Okay, so now you say, okay, I need an edge. I have my method. I know I need an edge. Well, now you got to make sure you develop edge the right way. I've listed some of the things people do when they develop a trading system. They curve fit, they over optimize, on and on. They trick the software into giving fills where fills wouldn't exist. Hindsight bias, all sorts of stuff. You got to know how not to do that. The tough part about that is a lot of these things you don't even realize you're doing until you take a system live and it starts losing money. But you got to avoid them. And just to go back, if you don't know what curve fitting is or over optimizing or how many variables is too many, do some research. Figure it out. There's people who teach this the right way or a good way to develop edges. Because ultimately you want something that looks like this. That's a good system. I wouldn't say it's like a holy grail type system. It's got drawdowns, it's got flat periods. But the key is you want it, let's just say you stop developing it around trade 400, and that was your back test, your walk forward. If you did walk forward, you did a walk forward back test. And then let's say you want it to continue on. And in this case, if trade 400 was where the system was developed, sure, it continues on. That's what you're looking for. So there's information out there. A lot of it's free. Some of it you probably have to buy, but you can certainly find out what all those drawbacks are and how to find them. The next thing is to play the right game. And this may sound kind of simple, but you'd be amazed how many people I talk to who talk about scalping and how they want to scalp for a tick here, tick there. And guess what? The people they're playing against are high-frequency traders. How are you ever going to compete as a retail trader with people who spend millions on infrastructure, on, the highest of high-speed access to the exchange, co-located servers? They have PhDs on their staff who are just doing nothing but analyzing to just extract ticks here and there. That's who you're playing against if you're scalping. You don't want to do that, because it's going to be like this. You're going to be this guy, all happy and smiling, not realizing there's this huge shark ready to devour you. And that's what happens. High-frequency firms love to scalp, love to be market makers. And if you try to do that, and I know a lot of people who have, it just doesn't work. It's not going to work for you. So you got to play the right game. Knowing not to scalp is a step in that direction. Next point, got to be properly capitalized. Why does that matter? Because you could get wiped out with a winning system. What do I mean by that? All right, let's do a coin flip game. Biased coin. You're going to win. Let's say it's biased towards heads, and you call heads all the time. 60% of the time you're going to win $100. 40% of the time you're going to lose $100. So it's biased. There's no other tricks. Long run, you're going to win with this coin, right? If we keep flipping it, you're going to win 6 out of 10 on average. So for every 10 times I'm tossing it, you're going to end up $200. You'd play this game all day long. But the question is, how much capital do you need to not get wiped out? So I'm going to put it to everybody here. Just type in the amount of starting capital you think you need to not get wiped out playing this game. Is it $100, $200, $500, $1,000? Mikhail says $1,000. Rick said $1,000. And we'll see a couple other people chiming in with some different answers. There's a 500. Somebody said around 1,000. There's another. Seems like most people are around 1,000. Somebody's saying 4,000, 3,000, 5,000. Alan said that. Vincent said 20,000. He really doesn't want to get wiped out. Okay, so we have a pretty big range there. Here's some results. This is a Monte Carlo simulator that I use to do this. You can get this off my website for free if you want it. And you can see over here on the left, I have 6 $100 trades and 4 minus $100 trades. I'm going to start with a certain amount that's in this orange column. And let's see what my risk of ruin. So a lot of you said $1,000. Well, you have a 2% chance of getting ruined there. So that's not bad. With $400, it's a 20% chance. And actually, Here's what it looks like when you look at it as a curve. Let's just say you started with $200. You have about a 50% chance of getting wiped out. If you really wanted to be safe, you want to be a risk of ruin around zero. And that's probably around $1,500 or more. Even at $1,000, you have some chance of getting wiped out. What's the point? Well, the point is you can lose and you can fail playing a winning game. And think about trading. You're not even sure that your edge is continuing, so you've got that uncertainty. But it just says, hey, if you're undercapitalized even with a winning trading system, you could easily get wiped out. It's funny, a lot of people are amazed to see that they could play a winning game and get wiped out. But if you play with $400, you're going to get wiped out about 20%. You have a 20% chance of getting wiped out. That's pretty big. So this kind of ties into number 8. You got to understand basic probability. So you got to understand what risk of ruin is. And, just some simple statistics. And if you do confidence intervals, if you don't know what they are, hey, you need to spend some time and research it. But the big thing is you got to realize there is uncertainty in everything. Everything. There are no certainties. And people over and over get into trouble when they think something's certain. Oh, hey, the last 3 times I've seen a pin bar with this kind of price action, the market's collapsed, so it's going to happen again. So I'm going all in. There's uncertainty in it. For those of you who have seen the musical Annie, the sun will come out tomorrow, right? It always does. Well, there's a chance it won't. And that's what you got to be prepared for. You got to be prepared for those days where things don't work out quite right, where the certain becomes uncertain. Along those lines, you got to be psychologically fit. This is a business. You're up against other retail traders. You're up against professionals. This is their business. Things like sim trading, totally useless for emotions. I don't even recommend sim trading, especially for discretionary traders, because I think it just changes how they work. If you like gambling, if you get a thrill out of trading, ooh, yeah, I won today, and I see a lot of people like that, you're probably going to fail because you're too much of a gambler. This is like a business. If you owned a fast food restaurant, you would treat it as a business. This is the same thing. Trading is a business. The problem is, when you're dealing with money, with anything, it just takes a long time to get used to the money not being a problem. It distorts reality. It plays with your emotions. Oh man, I lost so much today. I could have bought myself a new car. That kind of thing. This is a big one. We talked about edges, and certainly you won't get anywhere without an edge. But if you're not psychologically fit, if you don't have the right mindset for trading, you're going to fail. Guaranteed. And part of this is you need to be dedicated. Remember I said how I love doing this, trading and developing strategies. You've got to love doing whatever you're doing with trading. If you don't fully love it, if it's a grind for you, I got to trade today, you're not going to be sharp, and it's going to come back and bite you. And you got to constantly improve. Every industry is like that. Think of cars. Cars 20 years ago were not built nearly as well as cars today, right? You got to constantly aim for improvement. So you got to be dedicated to do this. That's how you succeed. And then you got to put all that together. Wow. So all those other 9 things, you got to really have them all. And if you don't, if you're lacking, if you have everything except you have this gambler's mentality to trading, you're going to fail. If you have everything except an edge, you're going to fail. If you think you have an edge and you developed your system incorrectly, you're going to fail. It's amazing how easy it is to fail in trading. I'm constantly amazed that the market can always figure out how to take money from me when I do something wrong. And I don't know how it does it, but it does it. And it'll do it to you too. So you need all these things to succeed. So here's an example. Let's just say you didn't have an edge. You'd never tested an edge. You don't know. You're just guessing. And you're undercapitalized. What's going to happen? Right, you're going to fail. Well, let's say you have a lot of money, but you still don't have an edge. Well, guess what? You're still going to fail. What about the flip side? Let's say you have an edge, like our coin flip game, right? And you're undercapitalized. What's going to happen? You're going to fail. The only way you succeed with these two, you have that edge and you're properly capitalized. So think about that relative to your past experience where maybe you were undercapitalized. Well, undercapitalized, no matter what, you're failing. What about if you didn't have an edge? Well, you're failing. And you can do that with all of these points. And if you're missing something, you're going to fail. Simple as that. And you might say, well, really? And I'll say, that's why 90% of people fail, probably more, because they're missing something here. They don't have this whole package put together. At some point, they've either done something wrong or they're missing something and they forgot to do something, and they're going to be one of those fail boxes. It takes all of that to succeed in trading. So again, what are they? You got to ignore the BS. You got to be just skeptical of everything, especially the more hyped up it is, the more you got to question it and maybe ignore it. You've got to have realistic expectations. I can't tell you how many people who've come to me and say, well, hey, I need to triple my money every year for the next 5 years with a 10% drawdown or something just as ridiculous. And they get mad. And when I tell them trading's not for you, they get really mad. I get people who get really mad at me. And I'm like, well, I didn't make the rules. I'm just telling you what they are. You don't want to hear reality. Got to have realistic expectations. You got to have a method. And you got to have a plan to how you're going to attack all this. And then you got to find an edge. Right? You got to make sure that what you're doing makes money. So part of that is making sure you develop the edge the right way. And I can't tell you how many people pick up a book, read it, and rely, that person detailed a method or something and maybe showed a couple examples where it worked great, and that's their proof, and they think now they have an edge, and they go off and trade it. Sorry, it doesn't work that way. I wish it did. Given all the trading books I've read, I would have done a lot better a lot sooner. But you got to develop an edge, and you got to do it the right way. Then, of course, you got to play the right game. Play where you can make money, where your competition aren't high-frequency firms. So what does that mean for people trading futures? It's kind of what I do. I do a lot of swing trading, where I'll be in trades for days or weeks. And I'm not making a ton of trades. So the high frequency people are not taking a lot of my money. Maybe they take a little bit on entry and exit, but they're taking a lot less of mine than they are somebody who's trading 50 times a day. Obviously, you got to be properly capitalized. Number 7, you got to understand probability and realize that things aren't always certain. And then you got to have the psychological part of it and then put it all together. And, I make that sound kind of simple. Oh, hey, this is all you got to do. But some of these things could take years, to be honest. Obviously to be properly capitalized, you've got to work and save money for a long time, right? Or get lucky somehow, get an inheritance or something. But you want to be properly capitalized. That takes a while. You want to be psychologically fit. It's not going to happen overnight. And somebody's saying years will be too long. And that's very true. For a lot of you, you need it now. But I'll tell you what, if you don't put the time in, a lot of times you'll never get to that point. Most new accounts lose, I think I've heard, within the first 3 or 4 months, and they blow out. That's kind of like an infant mortality type rate for a lot of traders. So it takes a while to do some of this stuff. But if you're realistic up front and you don't think you're going to make money starting tomorrow, you have a much better chance. Okay, well, we're going to do some questions, answers. I've got as much time as you got questions. And in the meantime, or when you get a chance, if you like what you kind of heard today, I realize I probably was a little blunt with some of my stuff, and some people don't like hearing that. They want to hear the dream. Well, I'm kind of telling you some of the reality behind this. Go to my website, kjtradingsystems.com. Lots of videos, a quiz to see if algo trading's for you. You can download a toolkit. You can get information if you want any of my stuff. But like I said, I'm not here to do a sales pitch, but, just in case you're looking. And with that, you can type in some questions, and I'll take a few minutes and answer a bunch. And if there's other questions you don't want to ask here, feel free to email me, kdavey@kjtradingsystems.com. And I'm pretty good at answering people's email, so feel free. But hopefully this kind of gave you a sense of, hey, it looks like everybody's making money out there. 1, that's not true. And 2, the people who are making money worked really hard to get it. So I'll give you a couple minutes to type in some more questions. It can be on this. It can be on anything trading related too. I definitely want to keep it going. Okay, so we have a question. Did going slower help you to achieve better performance? And that's a question from Michael. And so going slower would be using longer period bars. So instead of using 1-minute bars, you use 60-minute bars, 120-minute bars, daily bars, that kind of thing. And the answer is yes. And you might say, well, why? Well, usually the market has a lot of noise in it, right? There's a lot of bouncing around with no real trend, and the market just goes up, up, down, down, down. On 1-minute bars, it's hard to pick out the signal from that noise. It's hard to separate the two. Where if you're dealing with daily bars, that's usually a little bit easier. Yeah, there's noise, but it's a little bit easier to see trends. And what I've found is a lot of times developing systems on those type bars is easier. So for my own trading, I did find performance did improve when I went to those longer periods. Now, at the same time, I'd still like intraday systems, and I'd still like to develop more they're just a lot harder to develop. So hopefully that answered your question. Mikal is asking, how complicated are your most complicated algorithms? Well, that's a great question. I am a big proponent of keeping things simple. I see people out there who have 50 rules and 50 variables that they're optimizing, and their system takes care of everything. I know people that have 20 to 50,000 lines of code in their little algorithm. I don't do that. To me, the ideal would be one rule for entry, one rule for exit. That is what I would consider my ideal. So what are most of mine? Those are hard to do where you only have one rule. So usually I try to have a couple rules for entry or a couple variables that I optimize and a couple for exit. I have some that basically are like 4 lines of code. If this, buy. If something else, sell short. If something, exit the buy. If something else, exit the short. I try to keep it simple. Now, what does that mean? Well, the bad part about keeping things simple, it usually leads to more drawdowns. People don't like that, right? It leads to more squiggles in your equity curve, and people are, oh, I don't want that. I want a nice smooth one. Well, you can get it by adding rules, right? But what I found is adding rules doesn't necessarily make things better. It just makes it look better in the past. And one of the keys to developing systems the right way is realizing that backtests are not necessarily indicative of future, especially the more you add to your algorithm. So I try to keep mine simple. They don't look as great, but they tend to match the past performance and the live performance tend to match a little bit better, and that's ultimately what you're looking for. Okay, so what? Chai, sorry if I pronounced your name wrong. What's your daily routine like for trading? Do you check the market once a day since you say you like to swing trade? Usually, for the most part, I'm running 24/7. My systems are running, like right now they're running. I usually check a couple times a day, and so all I'm checking there isn't that I'm making money, because that's not the important thing. In the long run, obviously it is, but in the short run, what's important is that your systems that you're trading are doing the right thing as far as you're in the right positions. If your strategy says be long, your real account's long, or vice versa. That is what I'm checking. So I go through a couple times a day, check my positions. Am I right? Or, did something go wrong with automation? Because that does happen, where sometimes there's recalculations, all other sorts of stuff. And you got to manually adjust your position. So I do that a couple times a day. And then most of my time would be spent developing new systems or re-optimizing old systems, which I do on a walk-forward schedule and that kind of thing. But usually a lot of those things, there's flexibility, so I'm not glued to the screen with the way I trade. So like today, this morning, I checked my positions, and then I spent a couple hours helping my kids do some things. And I can do that. And then I come back and check my positions. Yeah, they all match. I can go off for a little bit again. So, but I'll tell you, tonight, after this call, I'll probably go back and be developing systems. So, you want to keep that research department open, so to speak, of developing new systems. You want to keep developing new systems because you get better at it as time goes on. Your systems do get better, and you want to keep adding to them. I'm trading about 80 strategies right now, in about 20 or 25 markets, and I'm always looking to improve. It's that, remember I mentioned that continuous improvement. That's part of my daily routine. Okay, Vincent had a question. How to measure risk and position sizing in a portfolio? I read your book that you use Monte Carlo to simulate to return to draw, excuse me, return to drawdown portfolio. Do you use this way to evaluate the portfolio? Basically, yes. I've probably, since I wrote the book, it came out 3 years ago, I've incorporated some new things, but I do look at how the systems, all these different strategies in different markets, how they all add up. I also try to limit the amount of exposure in any one sector, because there's ways you could position size, and all of a sudden you find out 75% of your money is tied up in precious metal systems, and you don't want that. So I try to break it off into industry sectors. What are they? Precious metals, grains, softs, stock market indices, currencies, energies, interest rates. Those are the basic groups. So you want to keep those, and you want to kind of be well diversified within them. But basically, I use a lot of the same techniques, use Monte Carlo techniques, which helps simulate some worst case drawdowns. That's a good way to go. All right, Steve P is asking, do you have a maximum amount of variables that you use to trigger an entry or exit? What I like to do, Steve, is basically use one or two optimized variables for entry and one or two for exit. So that's always my goal, is never to have more than 4. Now, it doesn't mean I don't, because there's sometimes where I do have 4 or 5. I think it's as many as 8 variables that I'm optimizing, but ideally I like to use 2 to 4. And again, it's all about simplicity for me. It's all about making sure I don't over optimize, I don't curve fit. Think of the way I always tell people is think of 3 points that are just on a graph. You draw a straight line through it, you probably will hit 2 of them. Okay, well, that's a pretty good fit. Well, what if you drew a curve? You could probably go through all 3 of them. The curve is more complicated. It's a better fit, but it doesn't mean it's going to be any good at predicting it. That's what you got to keep in mind. You got to balance what's best in back tests with what's going to kind of work going forward. And that's where I spend a lot of my time doing stuff. All right, Steve W. Do you think the more indicators you know, the more systems you can test? How do you find your new trading ideas? I teach this in my workshop, but basically I am always on the lookout for trading ideas. And I'll see something in a magazine. I'll see something online. I talk to people, other traders, and they'll just mention something out of the blue, and it will trigger something. And every time I come up with an idea, I just write it down. And eventually, I hope to test all that. Now, the bad part about that is I have a lot more ideas than I have time to test, but I'm always looking for ideas, and I'll test them a bunch of different ways. And there's a right way and wrong way to do it. You don't test it on all the data, for example, because then you've used out all your data. Think of it as, you guys have all heard of carbon-14 dating, right? It's how you date an old antique, or something that archaeologists dig up, right? Well, let's say they dig up this big old dinosaur bone. Well, and they want to know how old it is. Would they want to test the whole thing? That the test would work, but it would destroy the whole specimen, but they'd find out exactly the number of years that this thing was, how old it was? Well, no, because then they destroyed it, right? then they wouldn't have it. They'd say, oh, well, that was 1,000,000 years old, but it's gone. Oh, well, that's bad. So they take a little piece of it and they test it. And they don't know it's 1,000,000 years. They might say, well, it's probably 1 to 2 million years, somewhere in there. That's the way to think about trading and doing back tests. You don't need it to be exact, and because when it's exact, you've used all your data, and that's not good. So I'm always on the lookout for ideas. I think the more indicators, I look at indicators, I look at patterns, candlesticks. I'll consider anything. Some people say, oh, you can't use indicators. Well, I have some indicator-based systems, some based on moving averages, believe it or not. RSI, those things can work. But the key is you test it and you prove it to yourself. And it doesn't mean it'll keep working, but it's usually worth trying. All right. We have another question. What do you think about using data mining or deep learning to get ideas for new systems? You got to be careful with that. What I've seen with machine learning, and there's software out there that will build systems for you, and they'll build millions of systems. What I have seen is a lot of times those are just curve fit type systems. Yeah, eventually you take 10 different indicators and stick them on a market in different ways. Eventually you're going to find something that works. I mean, it's kind of the theory of a blind squirrel will eventually find a nut, right? Just by walking around, he stumbles over it. That's what a lot of that data mining and deep learning, machine learning, that's what the drawback to that is. So you got to be really careful with that. Now, I've created some systems using some data mining, but I was careful not to use too much data. Again, it's using all the data, you're going to burn your system. Okay, I think, unless I skipped over some questions, there's some really good questions here. If you guys have any more questions, feel free to type them in. I'll stick around for another couple minutes. Otherwise, I'll let you go. And wait one more minute. And I hate silence, so I'll just keep talking while you guys are typing. But again, if you come up with something afterwards, oh man, I wish I had asked them this, send me an email. I'm really good about sending email and answering email. So I'm not one of those kind of people who just ignore you. I'll answer it. If I don't know the answer, I'll tell you. I'm not here to BS everybody. I think I know a bunch about trading, but I don't know everything. That's for sure. Okay, so we have couple last questions. One, Dave is asking, hey, missed the first 30 minutes. Is there another way to see a presentation? I'm going to be uploading a video, and you'll be getting an email for that probably in the next few hours, so you can go and watch that. Steve had a question. Do you find managing all the rollovers for 80 strategies hard to do? Do you have a rollover schedule? Yeah, I've actually created some little helpful tools, some indicators that help me with that. It's not too bad, but one of the things with the 80 that I'm trading, a lot of them are the same market, and I'm just trading the net position, so I'll have 3 soybean systems, and my net position's long 1, so I just have to roll over once per market. So I don't have to roll over 80 strategies, I just have to roll over each market, so that makes it a little bit easier. Vincent's asking what percentage of drawdown can you expect in a portfolio? It really comes down to the strategies you're trading, but 20% is not unreasonable. And again, it also depends on the amount of capital you start with and how leveraged you are. You can certainly get 80% drawdown in even in a portfolio, believe it or not, if you're kind of undercapitalized. So that's just something you have to look at and see where you're comfortable. My rule of thumb is your drawdown that you can really stomach is probably half of what you think it is. And what do I mean by that? Well, let's just say, Vincent, you say, hey, 20% drawdown, I can handle that, no problem. Well, when trading real money, probably what would happen around 10%, you would start to sweat. And you're like, uh-oh, this is getting bad. And then you get around 15% and you're probably almost in full panic mode. And even though you thought you could handle 20, you might not be able to, and you might get out before that. So it's just something, a nice little tip to keep in mind. Because I found that with my own trading where thought I could accept something, and boy, when you're really losing that much money, you can't accept as much as you think, unfortunately. Hersey is asking, question related to data testing, forward testing versus incubation. Would it be wrong to skip forward testing and just go to incubation? You could. I like doing walk forward testing and then doing incubation. Ultimately, but that's what works for me, and that's what I've kind of proven to myself works. But I have other people I know who do things differently. Ultimately, no matter what I say or anyone else says, ultimately it's your own account that will tell you if you're doing the right thing. So if you want to try it without forward testing, do it for a while and see how it works with real money. And you'll say, oh, hey, I don't need to do this kind of testing. Kevin does it, but he's an idiot. I don't need to do it. And that's ultimately the ultimate proof. And Thomas is asking, how many strategies do I use at the same time? I'm trading about 80 right now. So I'm trading systems. And at any point in time, some are long, some are short, some are flat. And I just have it set up that I trade the net position. So right now, I know with the mini S&P, I'm actually flat. So, I'm probably in three or four of my strategies have positions, but the net is 0, and that's what I trade. I trade the net. I don't have to trade each one individually. The way I have it set up, it just trades the net. And what's nice about that, if they're uncorrelated strategies, you get a lot of diversification. So out of my 9 ES strategies, probably some are counter trend following, some are quick in and out, some are intraday. I got a whole bunch of different kinds. And hopefully over time, they each have an edge. They each add profit. But then when they work together, they kind of smooth each other out as far as drawdown. All right. Well, it looks like I think I've hit all the questions. If I missed your question, because there were a bunch, please just feel free to email me and say, hey, you missed my question. If you get a chance, go and visit my website, kjtradingsystems.com. Tons of free info there. And like I said, feel free to email me, and I'd be glad to talk to you. All right. So thanks, everyone. Thanks for attending, and have a good afternoon, evening, night, or tomorrow. All right. Thanks.